Welcome back. Markets are rallying this morning following a turbulent day yesterday. The Dow Industrial's up 204 points right now. S&P 500 higher by 29, and the Nasdaq up 143. Stocks rallying after yesterday's volatility. The S&P 500 closed in correction territory. The Dow seeing its lowest close in about 8 months on the heightened geopolitical tensions. Joining me right now is the founder and editor of the Bear Traps Report. Larry McDonald is here. Larry, great to see you. Thanks very much for being here. I want to kick it off with your thoughts on the tensions between Russia and Ukraine. How is that impacting markets?
Well, Maria, it's fascinating because since November, the street and the Fed have been ratcheting up these rate hike expectations from 3 to 4 to 5 to 6 to 7, and they really overcooked the goose. And now what's happening is the threat from Russia, Ukraine, to the global economy, plus inflation, those two dynamics are already hiking rates for the Fed. So we're about to witness a really historic backtrack in what they've promised. And if they go forth with the current plan, they're going to put us in recession very fast.
So do you think we are going to get a 50 basis point hike in March or not?
Yeah, I think the Russia-Ukraine dynamic has taken that off the table. But a strange thing is happening where we have rate hikes priced in for this year in the futures market, but rate cuts like in 2024 are starting to price in. So the market, the bond market's telling us something very ominous is happening under the surface.
So tell me what the bond market is saying right now, because you just mentioned a moment ago that if we were to see these rate hikes, the Fed will take us into recession?
Exactly, because inflation and global tensions in the Ukraine are already creating a contraction in consumer confidence and spending. So at the end of the day, the bond market, say the 2s 30s or 5s 30s, that's if you look at treasuries. If you look at stocks too, the XLP, which are the recession-proof companies, you know, your Campbell Soups, your Walmarts, your Costco's, they are dramatically outperforming the S&P and the Nasdaq by the greatest measure since prior to the last previous recessions. In other words, if you go back the last 40 years, when the defensive stocks act like this, we're heading toward a recession.
You know, add on to that the price of oil, and you've got to believe that higher gasoline prices, higher crude, heating oil, cuts into wages, cuts into disposable income for the consumer. So that could add to this idea that we are looking at a potential recession. Prices this morning are lower, of course, by 0.25%. But you're still talking about a market that has been elevated now for a year. You're basically moving back off of some of these big moves in energy stocks right now, right? How do you want to invest around $96 a barrel Brent right now?
Exactly. You and I did segments last year and the year before, and we were pounding the table together with you. We were pounding the table on energy. Now, we're seeing a massive backwardation in the energy complex, similar to the one right before Lehman. It's a sign of a blow-off, a near-term blow-off top in energy. But the one dynamic that's wacky beyond belief is Apple is near a $3 trillion valuation, right? It's pretty close. But at the same time, 50% of the NASDAQ is down 50%. So one of these two things is dramatically wrong. Either Apple has to come down, 10, 15, 20%, or these beaten up tech stocks have to come up. I think that the indexes are in for a potential near-term crash here because they're being held up by a few darlings, what I call the crown jewels. But under the surface, there's already been a substantial crash.
So are you looking at growth crashing? What kind of a quote-unquote crash are you talking about?
Well, I think the Apples of the world, the FANGs could drop the next 6 weeks 20%. But on the other side of the coin, your SaaS stocks, your biotechs, some of your value names like Intel. Intel is a screaming buy down here, 3.3% dividend. The dividend has almost doubled over the last 10 years. So, and you're talking about a stock that has been beaten up. So there's tremendous value in the market, but there's also tremendous froth in the large mega caps.
Yeah, I mean, what about that? Because the S&P 500 is now in correction mode. Look at some of the S&P names that have done really well. For example, the financials. Do you want to still buy financials, or has that ship sailed as well?
Well, we still love like global financials, global value, like the EWU ETF, which is a basket of global commodity plays. That's dramatically outperforming the tech stocks in the United States. And so really your global value, your financials, your Glencores, your companies in the commodity space like Tech Resources. David Einhorn has a nice stake in there. He's done very well. That's a copper play. So your copper plays, your uranium plays, your coal plays, those hard asset plays are dramatically outperforming the S&P this year and the NASDAQ, and that's going to continue for the next probably 18 months.
But don't those companies, aren't they tied to the macro story? I mean, the Federal Reserve is defending this economic growth narrative that supports rate hikes. But you say your data tells a different story. Get me back to the Fed. You said that the Fed, if it does as aggressive moves as a lot of people are expecting, it will take us into a recession. So what do you see as the realistic narrative in 2022 as it relates to the Fed?
Well, think about 2014, 15, 16 in that period. They were supposed to hike 8 times. We got hit with a Brexit in 2016. We ended up hiking once after the election. So once again, they were supposed to hike 4 times in the election year, and they waited until after the 2016 election to hike. Now we have a midterm election coming with really a lot of inflation already slowing down the economy, and they're promising all these rate hikes. The probability of them basically being forced to walk back these rate hikes is so high. So your gold miners, your silver miners, I think gold could be 3,000 by the end of the year, maybe first quarter next year, because at the end of the day, if they walk back their promises of hikes, that weakens the dollar, and then that really gives a boost to other commodity assets, hard assets.
Wow, that's a big call. Gold at 3,000. It's now at 1901. Larry, real quick, are you increasing your exposure to gold as well?
Yes, we've been the last 3 months, gold's been in a really horrific capitulation. We have trade alerts that go out via WhatsApp. We have a Bloomberg chat with hundreds of institutional investors in about 23 countries. And we've been recommending gold, silver miners, hard asset plays that will benefit from a Fed that has to kind of like do the walk. I call it the Michael Jackson moon walk back is coming.
That is great. I love it. Larry, great to talk with you. Thanks so much.